Hello and welcome to Property Matters. I'm Stephen Galpin, and today we're going to be talking about how the finance criteria has changed for our developers up and down the country. And helping me look at this is Peter Beaumont, Director of Stamford Finance. Welcome to you, Peter.
Good morning, Stephen.
I know it's your first time on our programme, so we'll try and be gentle with you.
Thank you very much.
But there we are. Peter, I want to start off by talking about valuations, which are really the guiding principle for a lender. I seem to have spent my life arguing with valuers about values, and we've gone through various stages where valuers, for various insurance reasons and protective reasons, have kept their valuations very low, which isn't helpful for the market because they're just not true values. We've had values in the past, especially places like here in Canary Wharf, where there has been a huge multiplication of developments all in one area. You have some valuers in the past who've said, oh, well, we can't value it up there because there's 20,000 apartments coming on the market in the next 2 or 3 years. Well, wrong. Red Book says you should value for today, in today's circumstances, and only in today's circumstances, not the future. We've then gone through periods where some of the big lenders have negotiated very, very low valuation fees, which is helpful to the borrower, I suppose. But actually, again, those valuers have tended to think, crikey, for the few pounds that we're getting for the valuation, we daren't go near our PI insurance limits.
Yeah.
So again, undervalue to be safe, because for the benefit of our viewers who don't know, a valuer can be sued by a lender if their valuation turns out to have been perhaps over-optimistic, shall we say. It doesn't often happen, but it can happen. How are you viewing valuations at the moment? Are you finding the industry is being fairly accurate and helpful to you?
I think valuation is a very tricky topic for a lot of our clients. I think working with a valuer that truly understands your geography is particularly important as well. So there's all sorts of panels, obviously, that these developers are on, but it's a very difficult market for valuers as well. We've seen massive shifts, massive political and domestic threats to the property market. So one valuer's valuation at X date is very different to another valuer's valuation on Y date. So we see massive moves in the market very quickly.
Yeah.
You don't have to look too far to see Kwasi's very brief stint as well to see how quickly the market can shift.
One of the downsides of everything going digital and being easily transferred from one party to another, if you do end up with a down valuation on a property, everybody knows about it within 5 minutes, including all the other valuers who you might want to choose as an alternative. And you're stymied, really, aren't you? I mean, it's
absolutely
difficult thing. So I think the need to be accurate is ever more important today. And again, we've come out of probably 15 years of cautious lending in the property market. That's both from a retail point of view and from the developer point of view. And, I think we need to get on a level playing field, don't we?
It's been a difficult market over the last 15 years, and you'd argue that we're still not quite out of it. But on the whole, there's positive signs for the market, and there's positive signs that developers are coming back to life, and that the market is coming back to life.
Some.
Yeah. I'm optimistic.
Good. Well, that's what we want to hear, a bit of optimism. Look, just moving on a sort of a broad subject, the government aspires to build 1.5 million homes by the end of this Parliament. I think everybody's fed up with talking about this, because I think most people in the industry know that it's totally unrealistic. We've gone from we're going to do it to being an aspiration or a hope or an optimistic thought process. But one of the things that concerns me a little, 1.5 million homes is probably about 300,000 homes a year, and we've never done that. We've never built those kind of numbers. And I think the government are forgetting that whether it be to a housing association, a private buyer, an institution for perhaps rental or whatever, all of that 1.5 million number of properties have got to be sold. They've also got to be built. So funding is needed for both. And my question to you is the funding available to support that kind of building volume?
Yeah, absolutely. It's not my favorite topic, to be honest, because as you say, it's unprecedented, isn't it? I think we saw it briefly 50 years ago, maybe, that sort of volume of construction, but construction's moved on as well. You know, building regulations have got tighter, planning permission has got harder to achieve. So we're putting all these hurdles in front of developers in the first instance, in any case. In terms of the funding for it at that point, those implications for building control, for warranties, for planning permissions is knocking on to development lending as well. So developers are finding it harder to access the capital to actually commence these sites. And again, you'd question, would they want to? Because as you've rightly pointed to, it's actually quite difficult to now get on the ladder. So unless you're an institutional looking to snap up some deals, the first time buyer is struggling to get on the market.
When you sort of look at this question, I just do feel that I think all governments they tend to look at one sector of the market or one particular situation, and that doesn't work. You've got to look at the market in the round, haven't you? It's no good, for instance, thinking, right, well, we'll penalise people at the top of the market for buying very expensive homes, and it doesn't matter because those kind of people can afford it. But they forget to look at the implication of that, what it means to the first time buyer who's not seeing the movement in the market that allows purchase onward and of course downward as well in terms of trading down a little. It's very difficult to get the balance right, I think.
Absolutely.
Okay, well, over London in particular, but I'm guessing probably across the country too, we're starting to see development projects being stalled. Now, why is that? It's a combination of things, I think. Building material costs are rising rapidly, and I think with the conflicts that have taken place around the world, the rebuilding of certain areas, and I'm thinking Ukraine, Gaza, etc., they're going to take a huge amount of rebuilding. Then, of course, that takes up building material. Worldwide shortages, I think, will start to become prevalent. Our big contractors will be looking for these profitable contracts abroad rather than here, where they know there's surety of payment by governments, etc. I do wonder whether you as a lender and somebody in that particular industry will be patient with development companies who either want to stall their development progress because they're nervous about rising building costs, or they're nervous about coming to market at a certain point. How do you cope with that as a lender?
There's geopolitical threats everywhere, firstly. So you've seen material prices 5 times, and once those 5 times have come in, you very rarely see it go back to that baseline cost. So that's the first thing. The market for lenders has changed massively, I would say. There's been a rise and an influx of private lenders as well, and non-institutionally backed lenders to try and combat this and give optionality to developers to encourage the development of the sector. You know, a lot of the traditional lenders that we have seen are drawing the same institutional lines. There's maybe 5 or 6 institutions that sit in the background that actually run the majority of our lenders. And we're seeing activity outside of those institutions now. And we've seen an influx of lenders that don't pull from those same pots.
Right. But that's good, isn't it?
It is good. It is good. It encourages healthy competition within the marketplace. I'm not necessarily convinced that all will stand the test of time, but we're seeing some creativity and we're seeing activity that would give me hope for the coming years, that there are people thinking outside of the box rather than just conforming to the tick boxes.
The reason I bring that subject up is because we were talking off camera, and I gave you an example of something I experienced many years ago when the chairman of a very popular sort of semi-sports car a manufacturing company was my next door neighbour. He explained to me that they were going to shut down for 2 years. They were going to re-engineer the plants. They were going to redesign the cars. They weren't going to shut any factories during that period. They were going to keep the same amount of skilled staff that they had. But believe you me, they were going to come back in 2 years' time with an amazing range of cars ready to hit the market. And I said, well, you know, super. But you can do that because you're government backed. And he sort of looked at me a bit strange. And I said, well, you know, you go to one of your high street banks and see how they react to that sort of plan. You just see how you get on.
Absolutely.
You know, and I just see shades of that coming back into the property development market.
Yeah.
Will the lender support you if you just take a very cautious step to when your product is going to come to market, which dictates when you're going to start building it? To move the subject on slightly, we've got all sorts of factors that are playing against the developer at the moment. We've got excessively long times of conveyancing. We've got material costs being, shall we say, volatile. We've got a resistance to developers' land banking, which I find rather ridiculous, because that's how you secure your future pipeline of product to build. I just don't get the government's point of view on that. So with all these factors coming together, how sympathetic can you be as a lender?
Again, it goes back to your choice of lender, and I think relationships. I know we mentioned briefly pre-air as well that the importance of a relationship isn't quite as prevalent as it would be now, but I do think there is a rise, and lenders are generally shifting back to that relationship-driven approach, and I do think there is a place for something that doesn't quite tick all of the boxes in terms of certainty of exit. But that being said, the world and our business and our industry cannot function if we just say we're going to sit on our hands until the time is opportune.
I sort of get that. Again, if I can just give you an example of something I've experienced. I know sort of many years ago now, I wanted to do a small development, and I went to my normal bank, who, well, now I've been with about 35 years and probably 25 years at that time, done several deals with them, all went perfectly and all the rest of it. And I said, well, you want to do this? It all stacks up. And he said, no, don't think so. And I said, well, why? You know, I've been with you all this time. We've done all these deals in the past. They've all been great. And he says, yes, and why would that affect my decision?
Yeah.
And I thought, crikey, this is the first time I felt the negation of loyalty, both ways.
Yeah.
I was a bit surprised. Then, of course, when you read I'm not a financial person, but if you read any of the financial press, we'd sort of moved over to a sort of American-style tick box of lending, hadn't we, I think? And I think, so I suffered that. Now, recently, over the last, say, 5 or 6 years, we've seen the introduction of specialist lenders, bridges, buy-to-let lenders, development lenders, and all this, that, and the other. And again, that's caused in its own way, again, disloyalty, hasn't it? Because you can't stay with the same lender. A bridger, for instance, wouldn't dream of picking up the long-term finance to follow the bridging.
Yeah.
He'd say, no, off you go. And
Yeah.
But I just see in the marketplace now a slight reversal of that, where lenders are starting to think, well, hold on a minute, if I've got a good client, good track record, why wouldn't I keep him? Because it's going to be cost effective to move on to the next bit, even though it's not our main focus, if you like.
Yeah.
I mean, am I picking that up correctly?
Yeah, absolutely. I think it's a lot easier to keep a customer, especially if you've done a good job for that customer, than it is to go out and find a new one. It makes no sense for me when, your case in question there, if you'd developed a tower block of 70 apartments, for example, you've got it to the stage where they're signed off and they're they're now needing to exit the development facility, why would the lender not want to roll onto that? It makes perfect sense. In my head. You've done the hard part.
Yeah.
Let them do the easy part.
Yeah. Again, the other thing is going back to my original point of all these properties that the government want the developers to build, they've all got to be sold at the end of the day. And it's always been a puzzle to me as to why lenders to the developer will never pick up the mortgage business that comes from the development. Why is that?
When most of the lenders are institutional and regulated. Yeah,
exactly.
Again, it confuses me. It's a tick box exercise, I think, a lot of the time, and a lot of those times you're chasing 0.2, 0.3 on a rate. So it comes down to those two factors. There's either a tick box that isn't quite satisfied there, whether it's so-and-so must earn £80,000 and they're only earning £79,000. So they don't quite tick that box, but that's a computer says no.
Yeah.
So
yeah.
And we lose that element, and we have lost that element of a sensible conversation as to actually, is that substantiated when I'm asking for a 20% loan to value mortgage?
Yeah. And is the market changing there in that way? No.
I'd say that's a slower process. Again, you've got the rise of the unregulated lenders in the bridging and development space as well, who can't actually offer those products as well.
Yes.
But again, the institutions are so long established that it will take time.
I mean, for me, I'm a little bit torn with the argument, really. In some ways, I like the idea of specialist lenders. I mean, if you've got a buy-to-let proposition, if you go to a buy-to-let lender, then he's going to understand you. He's going to understand the market, the position, your position. He's going to be able to talk turkey with you, isn't he?
Absolutely.
However, if that means you hopping around 3 or 4 different lenders to develop, build, sell, and then perhaps, sell on to buy-to-let, then, it's going to be quite complex, isn't it? You might end up with 3 or 4 lenders in the life cycle of the development.
Absolutely. And there's
can't be good.
Well, there's a few winners in there, isn't there? There's solicitors, there's probably valuers.
Yeah.
There's probably lenders as well with their fees, however they're structured. But again, when you talk about buy-to-lets, you see people skinning a cat slightly differently, but ultimately at the back end. So you might see a headline rate of 2% with a 5% arrangement fee.
Yeah.
Or you might see 5% with no arrangement fee. But ultimately, when you get to the tail end of that buy-to-let mortgage, it all looks the same.
Yeah, I suppose it does. Well, you hope it does.
Yes, yeah.
And assuming you get to the end.
Yes.
Yeah. I mean, again, coming back to this business of criteria for lending, it seems to me that if we want to hugely increase the amount of properties that are built in this country, we've got 2 issues. One is the issue of what exactly are we building and for who. And I'd be very loath to see it go back to the post-war sort of development process. A lot of prefabs were built, a lot of very low quality housing estates were built, a lot of local authorities constructed really very poorly designed and poorly constructed council estates, which have now really fallen into high levels of dilapidation, are causing some of the problems in the rental market. I just don't know quite, on a 4-year, 5-year cycle of government policies, I don't know how we're ever going to control that and get that balance right. Do you?
We're not.
That's an honest answer. Yeah.
We're going to see materials. We look at some of the materials that have been used in the high rises over the last 10 years. They're not fit for purpose. We've got building control, which is in a better place now, to make sure that the standards of production are better. But we're then seeing locations, trying to fit 5,000 houses into a place where the infrastructure doesn't support those houses. So we need to think really carefully about it, rather than just political gain and say we're going to build 1.5 million houses. There needs to be some strategy behind it, and it needs to support areas that actually justify those houses.
I mean, at the moment, it seems to me that it's a very ill-considered strategy, really. we need to be identifying what we need. I mean, if I can quote one of the big developers here, when they built a lot of the commercial units in this area, one of the developers in particular went out and said, oh, rather than just go for shop units and commercial units that will bring us the highest rents for the longest periods of time from blue chip clients, actually what we're going to do is go out, look at the demographics of who's going to be working here, and then try and get commercial tenants to suit their particular needs and status. And that was very bright, and it worked. And to some degree, we've got to do the same in the residential housing market, haven't we? We've got to identify where the money is to buy these properties, who's got that money, where it's going to go, and who it's going to house at the end of the day. Do you go with me on that?
Absolutely. The strategy is arguably the most important piece to this conversation, rather than, like I say, plucking a number from thin air that doesn't actually make a lot of sense, because we need to know where these sites are going to be. We need to know who's going to build them, and we need to know that they're actually going to be offered to the people that want them. There's no point in us building 1.5 million, £5 million houses, because we wouldn't have a demand for that, would we?
I was brought up in the Midlands, and there was a particular development there that was one of these huge housing estates. I'm talking probably 30, 40 years ago now. Huge housing estate. It was built, it was constructed, they were all sold or rented out or whatever. But the complaints for years going on was there's no schools, there's no shops, there's no social infrastructure to the area. And again, I think we've got to be very careful of that. Just because you find a field that will take 1,000 homes doesn't necessarily mean you should be building there. And I guess as a lender, you've got quite an issue there looking at these strategies over and above the commerciality of the deal to make sure that there is an exit strategy.
Yeah, absolutely.
I suppose.
Yeah, no, you're absolutely right. But again, you've highlighted another key point of contention for developers. They're paying fortunes of community infrastructure levies, Section 106s, which are meant to be ploughed back into the local community. But when you look at your local roads, do they look immaculate? Is there a waiting list to get onto schooling? Probably. Do any of these contributions actually make a difference to
where they should make a difference?
Exactly.
Yeah.
Exactly.
Yeah. I get that. Now, I think we're in a time where probably a lot of people are in the mood to develop. That they have the hunger and the desire to develop, but the facilities of doing so are not automatically there. And that's why I've been quizzing you quite deeply about whether you think the money is there to do all these things. I think the tone of your answers has been to say, yes, the money is there, providing the circumstances are right.
And there are so many great developers out there taking the bull by the horns, or opportunistically taking the market on at this stage, because it's not risk-free out there.
No.
But there are deals to be done, and there are opportunities to be had at the minute. So
I think the final point that I'd make with you, again, a worry that I have is that both with material shortages and development finance, I wouldn't want to see just the sort of top 10 house builders being able to control that position. In other words, if we have a shortage of materials because of rebuilding through these conflicts and things, is it just the big developers that are going to be able to flex their muscles and say, I want the materials first? What about all the small developers that are the backbone of our residential development market, aren't they?
Yeah, you could say the same thing about land banking again.
Yeah.
All of those land banks that Joe Bloggs that builds 5 to 10 houses a year might not be able to have any flexibility on. He has to build them regardless. The bigger developers are able to just say, okay, this site doesn't owe me anything. I'm going to wait to see what happens. That's where maybe we could see some intervention from a government to say, well, use it or lose it, maybe.
Yeah. Do you think the government does take enough notice of people attempting to advise it?
You've got a lot of industry experts out there that could contribute very valuably. I feel like a lot of those voices aren't heard or aren't even given the opportunity to be heard.
Yes.
I'd love to see some of those influential people within the space actually having a platform to speak out about what the challenges are.
And to get the correct understanding of the challenges, you've got to talk to the people on the ground, not the theorists, really, haven't you?
Absolutely, absolutely. It's very easy to stipulate plans and procedures from a glass box somewhere, but actually it is the men on the ground that are hearing the problems or seeing the problems.
Well, yeah, I mean, it's funny you raise that. I mean, just some of the funniest times I've ever had was when I was consulting for various developers, and the bank would send you out and say, go and have a look at this and see what you think. And you'd say to the bank, you'd say, has anybody been to see this before they lent the money? And they, no, why would we? We did a desktop this out, or, you know, and you think, yeah, well,
Yeah,
you'll be paying the price now.
yeah.
So that's it. All right, Peter, thank you very much for coming on the show this morning. I found your views very refreshing and highly intelligent. So thank you very much indeed.
Thank you very much for having me.
I'm sure our viewers will be eternally grateful. So Peter Beaumont, Director of Stamford Finance, thank you for coming on. Thank you for watching, and join me again next time on Property Matters.